Perhaps the most fundamental building block of an investment is whether it is an equity investment or a fixed income investment. These represent the two main ways companies can raise funds for their operations. Equities represent ownership, and there are a number of words that basically mean the same thing: stocks, shares, equity, shares of stock. These words tend to be used interchangeably. When a company raises money by selling an ownership stake to investors, the company has given up equity in exchange for cash for the business to use. Fixed income is the other main method for a company to raise funds. Instead of selling off a part of itself, it can issue loans. These are called bonds. If the company wanted to raise $100 million, it could issue bonds to investors. These bonds have an interest rate attached to them, and the company pays the bondholders interest on a regular basis until the bonds mature. At maturity, the company is supposed to pay off the amount borrowed. So again, the best way to think about the difference between equity and fixed income is that equity is ownership of a company, and fixed income is like giving the company a loan. This also helps explain the risk and return characteristics of equities versus fixed income. And remember, another way of saying this would be stocks versus bonds. With equity, we are very much tied to the fortunes of the company. If they do well, we do well. We can make a big gain on our investment. On the other hand, if they do poorly, we do poorly, and we could take a loss on our initial investment. With a bond, which is like giving the company a loan, the company could do really, really well, but we would only ever get our agreed interest payments and money back at the end of the loan. On the other hand, if the company does moderately poorly, we still get our interest payments and money back too. Keep in mind, these are general principles. It's possible for the bonds of a company that is in jeopardy to be riskier than the stocks of some other companies. If the company goes under, then you could lose a significant portion of your investment. Conversely, if it turns its fortune around, you may end up making a healthy return on the bond. Always remember the relationship between risk and return in investing. Higher possible returns come at the expense of taking on more risk. Generally speaking, equity tends to be higher on the risk versus reward spectrum, and fixed income tends to be lower on the risk versus reward spectrum.